Hello, again, Troy White, Hoodoo Financial. We're discussing more real estate related topics. Today, I want to talk about some of the advantages of owning uh, residential multifamily real estate. There are a lot of different types of multifamily real estate investment properties. Um, they fall into various categories, and we'll list a little bit of that. Multifamily, um, just in case you don't know, I mean, it's very self explanatory. It's a real estate type in which multiple families may live in the dwelling units. They are built in a way to sufficiently maintain multiple family units. So you enter one door, that door consists of a bedroom, a kitchen, a bathroom, maybe a living room and dining room and everything. But fundamentally, there are living quarters in multiple of the units of this property. So that's what multi-unit is fundamentally, but you have even within that category are different types of multifamily. They're residential. Residential just means uh, one when you and this is from really a defined by the lending standards. So when a lender is considering a property or analyzing a property, and the appraiser, they need to divide them into various categories. And so residential properties are fundamentally a property that has between one and four units within the physical structure. One unit to four units is a residential property. Now, residential multifamily specifically means in this dwelling, it is for residents only and multiple residents. So this specifically pertains to a duplex, a triplex, or a fourplex because it's residential, which is a one to four unit property. But residential multifamily means multi. Multi is more than one. So it's a residential property that consists of two, three, or four units within that physical structure. Commercial multifamily is a different category within the commercial sector. Commercial multifamily simply means it's a it's a dwelling, a physical structure that houses multiple family units within it, and it must be five or more. So when I say or more, it'd be 1,000. Five to any other higher number. So it's five or more. It is a commercial multifamily property. Okay. So what about these properties is what's the advantage of owning these type of properties? So again, we said residential multifamily is two to four units. And so I'm speaking on the advantages of owning residential multifamily properties. So there are a lot, but we're just going to talk about some of the basics for 10 minutes or so. So, first off, they're easiest to finance. So, when I say easiest to finance, any residential property is easier to finance than a commercial property. So, residential multifamily could potentially be easier to finance than a single family residential property, meaning a physical dwelling that only houses one family in it. That is in some ways more difficult to purchase than a residential um, multifamily property. And and when we say, and the reason is because of the loan to value ratio required. So first off, on commercial, anything commercial is going to require approximately 65%, or the lender is willing to lend at 65% loan to value. Now, I'm not speaking about the what was I talking about? I said it's easier to. I'm not talking about when I said the loan to value. I'm not really comparing in terms of if you were to find a deal and if you are using the tools and techniques to acquire the property with 100% finance. And I'm just speaking straight out. If you accept the value at the market price and what is required for you to to put as a to have what skin in the game you're gonna need, meaning what down payment, what level of down payment. So the loan to value. So your part is in excess of what, and when I say your part, the portion of the property that you must actually be the owner of, so that the lender will lend you the money to acquire the property. Your portion is could potentially be 35% versus in a commercial property. So the LTV is 65, 35 yours, 65 the lender, 35 yours. But with residential multifamily, you can do it with 20% down. So the LTV is somewhere around 80%. So that makes it easier. And the the income being generated by the units is counted as part of your income, even though you don't even own the property yet. So when the analysis is done to determine whether you can afford this property, the income that would be yours once you acquire the property is calculated with your current income level to qualify you by the underwriter to see if you can even step in and own the property. And there are different terms. You know, you need to put it. So on residential 1 to 4 units, what's required for your down payment is often it could be zero, and it could be only 10% requirement. But commercial properties, 5 units or more, you at least need 20%, but often you're going to need 35% often. And so also, the types of loans that you can receive are even different in terms of residential properties, 1 to 4 units, versus commercial properties. Um, you could get fixed rate loans on a commercial property. It's not likely that you're going to get a straight out fixed rate loan. That's not likely. It's going to be some sort of adjustable rate mortgage. Maximum terms 30 years on a residential 1 to 4, but a commercial property is likely to want this property paid for in 25 years. You know, it doesn't sound that big of a difference, but it is a big of a difference when you consider that it's amortized over a shorter term. That means shorter time horizon, which means your principal and interest payments will be higher because you need to pay it off faster. Um, Often balloon payments are involved with commercial properties, but residential 1 to 4 unit, it's not require balloon payment. But there are some scenarios, depending on how you get the property and who gave you the money. And they may require you to do that, but in general, that's not a requirement. and the interest rates are lower on the residential 1 to 4s versus commercial properties. And you have the ability to maximize. You can use that maximum leverage, as I already we spoke on that a little bit in terms of your down payment, and so you can leverage more. Is what I'm talking about. And then, of course, with other real estate investing tools, tricks of the trade, trying to get basically how you step into the property allows you to leverage even more of the properties. But that is true regardless of it's residential or if it's commercial. And so often the residential 1 to 4 units land in the right price range for your common investors, especially when you're getting started. We're trying to acquire our 40 units. Well, you don't jump in with 40. You can, but assuming you have to work your way up, then these 1 to 4 units are in the right price range in comparison. Because when you purchase a 2 to 4 unit property, duplex, triplex, fourplex, the purchase price is about the same as a single family residence of similar shape and size. So, for instance, I have a 4 unit building that is, I mean, it's not enormous, but a single family residence that is smaller actually costs more than my 4 unit. And you get less income based on, from the single family than you would with the 4 unit. And we're going to dive into that in other videos, but just in terms of the price range, is very comparable. Single for the 2 to 4 unit versus a house of the similar size. A house of the similar size is going to be similar to the same price. So, my thought process, well, why would I want to buy that? Why would I want to buy just fit one family in there? I'll buy the same kind of house and fit 4 families in there. Got 4 people paying your rent for you. Now, let's piggyback off that. Compare. Let's say if I have 4 families paying me rent in one dwelling versus one family paying me rent in one dwelling. Well, let's say this I got a mother, father in the single family residence, and in each of those 4 units, I got mother, father. So those are 8 grown folks. Well, I am at risk of, I have a higher vacancy risk in that single family residence because, first off, if they move, then that building is 100% vacant. But if only one of those families move out of my 4 unit, I'm only 25% vacant. I still have 75% of the income coming in, so I can to at least help me pay the bills, right? If at worst, in fact, let's keep on the same scenario I just mentioned. My 4 unit have a vacancy right now, and I mean it's finished and ready to rent. So hopefully it'll be filled soon. But the other 3 units are paying the mortgage and still putting some money in my pocket. So I'm at less risk of vacancy, there. Now, also, that single family, when that property is vacant, that means I don't have any income coming in. But then let's just say not even vacant. Let's not even say vacant yet. Let's say both of those folks, parents, lose their jobs, or if there was only one person working there, one person loses their job. Well, that puts my income at risk. So even if I needed to evict this person, it's going to take some time to do that. But again, in my 4 unit, if this person lose their income, I still have those other 3 units helping out. So it's the risk reward trade off that we're always trying to combat against in all investments. All investments, there's a risk reward trade off, and then the range of rent. Let's say in my 4 unit, I have 2 bedroom units. In a single family residence, you may have 2 bedroom as well. But the cost to rent the single family is going to be higher than the cost to rent the multifamily. And excuse me, when I for the same, you're not going to be renting the same square footage. You're going to get a lot of more bang for your buck on the range of rent. So the if a person can pay, let's say in my 4 unit, each one of those units may rent for $1,500. Actually, they're renting 1,300. But a single family resident is going to rent for approximately, in a similar size and everything, is going to rent for about 2,200. Well, the range of rent is better because I'm getting, although for in each individual unit is less, it's I got more of them. And so if at some point, if I try to get more rent for that single family, then it's not cost effective for the renter, because at some point they'll just go and buy their own house. If I raise it to, to try to equal what I'm getting in the multifamily. And remember, I said they're approximately the same size building. So in the 4 unit, each of the four is paying 1,300. So that's 26 plus 26 is 52, versus the 22 is the maxed out in the house that I would be renting. And so you try to raise that up to 52, then the person's gonna say, "Oh man, I'll just go buy my own house." So that's what I mean in terms of the rental range. And so then the multifamilies are easier to make improvements on. And remember, when you make improvements on a property, you are forcing appreciation in there, and you are forcing equity. By appreciating the property, you are getting appreciation forced in. So um, they're easier to improve because there's just one big building. it's just easier to improve in multiple ways, and partially because of economy of scale. So think about it this way: if you owned 4 single family residences, whereas I own a fourplex, well, if you want to make the same kind of improvements, you're going to have to go do that on 4 homes. If you need to improve the landscaping, the curb appeal, then I only need to do it one time. It's curb appeal, and I'm doing that right now. And that 4 unit that I'm speaking on is being painted. Of course, the weather's bad; they gotta wait, but they prepped it. It's ready to be painted. Got all kind of other little details being fine tuned on there. But if you got 4 single family residences, you need to do that all over and over and over and over. It's just more to it. And then I also want to point out on the multifamily properties, you can walk in with cash flow. So when you buy the property, when you buy it, it's cash flow coming. So as long as you did your numbers right and it's receiving rents that are over and above your mortgage payment, then you're cash flowing. You walk in with cash flow. Now you buy the single family residence, you're not necessarily walking in with cash flow. Your bet is on the appreciation, the tax benefits, and such. You're trying your best to increase the value of the property, but with the multifamily residentials, you're forcing that appreciation in there. You're walking in with cash flow. And also, you are likely to get free money at closing. And that's because there's a prorated portion of the rents that need to come to you. So and it could be used against closing costs and things like that. But let's just say if it's just a straight up, you buy the house and then um, regular loan, then you're going to receive, especially if you buy it right at the end of the month, then and that's what happened to me a couple of times. You get the property at the end of the month, and then hey, the first is tomorrow. Those people pay their rent to you. So that's what I'm calling uh, free money at closing. And so those are just some of the benefits, and there's a 0 to 10% down potential on a 2 to 4 unit, and there's a more affordable purchase price. Uh, the range of rents is more conducive to you to make this better income, make income above expenses. Um, there's safety in terms of the risk of vacancy because you won't be 100% vacant when that family moves. You can get immediate cash flow. Of course, you need to buy it at the right price in the right terms. There's potential cash back at closing. It's economies of scale. You need to fix the roof. You only need to fix one roof. Whereas if you have four individual homes, you need to fix four roofs. That's, quadruple the cost, literally. Um, you can have the potential to get a fixed rate mortgage on your properties on a 2 to 4 residential. You can get a 30-year term on a fixed on a residential purchase. Residential 2 to 4 unit. Interest rates can be, you get the best type of an interest rate on a residential anyway. But so you have the potential for better interest rates, better terms in general. And, those are just some of the benefits of owning the multi-family residential properties, real properties, as from an investor standpoint. Thanks for listening.